Hi everyone, and welcome to the next episode of the HeelanHub Podcast, the show for small business owners. I'm Dan Heelan. On today's show, it is just me back to you to talk just before the end of the UK's tax year. Now, as a business accountant, that's pretty exciting. And firstly, I just want to apologise if you're a regular listener to the show for the gap. I think it's the first time in all the years I've been running it. We've had a sort of a month gap, maybe a little bit longer. So apologies for that. We've just been cooking a lot in the background of the business. We've had a very busy period, making loads of new cool services for clients. Just expansion's been fantastic. It's a first world problem, basically. So I haven't had time to sit in front of the mic and then mix in some illness in there. And it's been a bit of a nightmare. I'm recovering from a cold as we speak. So hopefully not going to be too nasally on this one. As always, you can listen to this. Most of you are getting it from Spotify, but we've also slinged them up on our side YouTube channel. So just search for the HeelanHub. And if you really wanted to, you can watch me talk to camera as we do this. So then, today's show, I really want to talk about last minute tax savings that we've got. So you have the whole of the tax year. So recap, if you don't know, the UK tax year, for weird, odd historical reasons, goes from the 6th of April one year all the way around to the 5th of April the following year. So as we're recording this and as we're releasing this, you've probably got a few days to go, but that's still time sometimes to just at least think about some of these things. And even if you think, actually, I'm not going to bother this year, then ready into the new year. I will probably revisit this early on in the new tax year as well to talk about some of the things you should be considering, because weirdly the things you consider now at the end are also some of the things that you consider into the new year. So it doesn't matter which side you're listening to this in, there's going to be some value into it. So let's get into it. So then, in this show, what we're going to do is we're going to run you through, mainly, I'm going to take it through in various stages. So whether you're a director of a limited company, or you're a sole trader or a partner, or maybe you're a landlord and you've got some personal tax affairs, there's going to be something for each of you. And quite often I'm going to bounce around because it's relevant to various different parties in this. So do stay with us throughout it. Unfortunately, with audio, there's not many timestamps that you can skip to, but hopefully, depending where you are on your business journey, all of this might be relevant to you at some point. I think it's nice to know how the other half lives sometimes as well. Let's say you're a sole trader. What's that like being a limited owner? What would I have to consider? Those kind of things. And as always, accounting caveat, there are some issues in here where I'm going to say it's probably a good idea, it's usually a good idea, it's generally a good idea or not, but it might be in your scenario that is not true. So never believe just some random on the internet. Get some one-to-one advice, do your research, make sure that you're completely happy. So let's get straight into it then. So I'm going to start with personal tax. So that's pretty much all of you. And as always, these podcasts are always about UK small business owners. So it's always from that angle. So the first thing I would do this time of year is gather your records. Now, whether you prepare your tax return because you're a sole trader or maybe you've got a limited company, it's a good time this time to just make sure you've got everything together. When it comes to doing your personal tax return, if you're a successful director of a limited company, you're probably taking profits in dividends. So you're going to have a personal tax return to declare and pay the tax on those dividends. If you're a sole trader, you're all aligned with the tax year now, so you'll have a tax return to do after the 6th of April, and that's going to be important, and it's going to be even more important as we talk about the Making Tax Digital rules. So you're going to gather all of those records now. It's just a good time to kind of get into the spring, tidy up your office, get everything together, and you're specifically looking from a personal tax point of view for things like, have I made any gift aid donations, which we're going to talk about in a minute? Have I got any interest? Did I actually sell some crypto in the year? What things might I need that's going to be really relevant to my tax return, and gather those now. If you're a sole trader, you want to be updating your records ready so that you can see where you're at. And particularly if you're in the world of cloud accounting software, you can actually see what your profits are looking like now with a few days to go. And as we're going to discuss in a minute, you might make some decisions in terms of spending money to go and do those, to go and spend that money and then potentially save tax. But it starts with those records. And if you've heard me talk on this subject a lot, I often say the best way to save tax starts with the easiest thing: keep good records. And that's because we want to capture all of our expenses. So you've got to make sure that, if you did any business mileage, in personal cars, have we got that in our records? Is that entered in our spreadsheet or on our Xero or our QuickBooks or whatever other software we're using? Just make sure you take some time to think about it. Now, mileage is particularly relevant because it's the limit on the two different fixed mileage rates. So you can go back and look at other shows we did on this, but you get 45p for the first 10,000 miles in a tax year, and then you get 25p per mile. So it's important to capture all of those things inside of the tax year and record them correctly to make sure that you've got everything out of the limit that you need, or you've not gone over the limit, and then you know where you are moving into the new tax year. And that's whether you're a sole trader or whether you're a limited company owner. Because even if your limited company could have a different year end. It doesn't necessarily run from April to the end of March. It could be like a June year end, but the mileage allowance in this example is still tax year. So it's worth just bringing all those things in. Then I'd be thinking about, we talked about crypto. So I'd be thinking about, capital gains allowance. So every individual UK taxpayer generally gets £3,000 that's capital gains free. So some people might use that to, I don't know, move their share portfolio around. They might sell some and reinvest them in something else and capture a little bit of a gain there and sort of crystallises it, as it's known. Sometimes that allowance can be useful for doing that. Sometimes you're already thinking, I'm just going to get out of crypto, I'm going to sell it. But you selling some now before the 5th of April and some after means you've got 3,000 allowance to use now and you can't carry that forward. So next year, if you split the gain, you might be able to then crystallise some of the gain next year. That's going to be quite important. I think one of the things that I haven't mentioned in here that's very specific to business owners selling shares is if you're coming out of a business, you're exiting a business, there's something known as business asset disposal relief. It used to be called entrepreneurs relief. And it's actually, you can get it in lots of different circumstances, but exiting businesses, it's very top of the mind at the minute because I've been doing a lot of it over the last 12 months for people. And the rates on business assets disposal relief goes up by 4%. It's going to go from 14 to 18% once we cross the line. So there's a lot of activity right now. There has been from January onwards. It's one of the reasons I've not been as available to do these kind of podcasts. I've been working with a lot of people, trying to get these deals across the line for people. And that's happening. So when we talk about capital gains, you've also got to consider, is there anything with business asset disposal relief or entrepreneurs relief that needs to be closed before the 5th of April? So make sure you capture all that as well. So big bit on capital gains there. Then we're having a look at making the most out of your tax-free personal allowances. Now that we're going to talk is more about in a company tax point of view, but most UK taxpayers will have about £12,500 personal tax free. Obviously, if you're earning over 100 grand, 125 grand, whatever, you're going to end up with what they call a restricted personal allowance, where that allowance is either going to be coming down or it's going to not exist. But this isn't where we're talking about this. We're really talking about actually, let's look at people that aren't using it. And there might be some reasons why you would want to declare some salary for your limited company. So I'm going to sort of put a pin in that one and come back to it. But I would say that if you're in the bracket where you're starting to lose some of your personal allowance, then actually you could consider making a personal pension contribution, because that will adjust the amount that when it comes to calculating that personal allowance, it can adjust it slightly to help you with that. So there are things that you might want to do to actually adjust that personal tax-free allowance. You can also make some gift aid donations when we're thinking about potential tax reliefs as well. So if you are thinking, I'm going to give some money to charity, if you're a higher rate taxpayer, can actually have, so that's somebody who's earning over sort of combined £50,000, there can be some immediate tax relief given on your tax return that helps. And it's the same with that personal pension contribution we're talking about. If you've got a desire to pay into your pension and you're in the higher rate of tax, it can actually have a good impact on your tax return. Now, if you're in the basic rate of tax, so you're under 50,000 and you make a personal tax pension contribution, it's still good, still going to help the investment, and the investment pot is going to get a tax top up and all the rest of it. But it doesn't really have any impact massively on your tax return. If you're, in fact, if you're earning under 50k, I'd argue there is no tax benefit. Not that you would feel like. So, but now is a good time to consider making pension contributions if you want to be in those things. Unfortunately, us mere accountants can't tell you whether it's a good idea to invest in a pension generally. It's regulated financial advice. But from a tax perspective, it makes a lot of sense in a lot of places. And when it comes to limited company owners in a minute, you're going to see there's a better way of doing it probably than making a personal contribution. But for those of you, when we're just talking personal tax, maybe you're in the higher rate, maybe you're in potentially additional rate, you're losing your personal allowance, that kind of stuff. You really want to have a look at whether making a pension contribution is going to help you. Now, going back down the income scales, if you're under £50,000, you might consider what's known as marriage allowance. And it allows you to transfer like a fixed amount of your personal allowance to your spouse. And it's very hit or miss as to whether and when that's appropriate. But if they're clearly, like, let's say you've got a non-working parent who's the primary child carer and one of you is earning 40 grand, you could transfer some of the money, and in a lot of scenarios that would work well. There's an online form to do it. It's very simple, but it generally only works super well and easy if one of you is earning next to nothing in that sort of scenario. But it is there, so do consider it. Now, on top of that, there's the boring stuff where it comes to investments. I know we're jumping around a bit, but you can consider whether ISAs, you've got an ISA allowance in cash you can use, and an ISA allowance generally, you might want, and they're sort of per tax year, so you might want to consider putting more into it. Again, I would always say with people with that one though, is do your research about whether you think it's a good relief in terms of your investment. I think I've come across plenty of financial advisors that still advocate for this, so I doubt you're doing anything wrong, but it's worth thinking about the various different interest rates you get, like any sort of investment decision, and weighing that up. But so ISA allowances, if you're going to put some money somewhere, you might want to consider that. If you've got excess money, so this tends to be and this is a stereotype, it tends to be with people that are a little bit older and they're thinking, look, I could do with getting some money out of my estate. So I'm going to get inheritance. It's more an inheritance tax save, but I could gift maybe £3,000 under my gift allowance to somebody. Now, there are conditions with this, but there is a gifting allowance. You can gift some money to other people. Might be worth considering if you are swimming in money. Don't come across it too often with business owners in the early journey, but in late journey, absolutely. And then when we're talking about children and family members, if you're claiming child benefit because you've got young kids, there is a clawback. You know, by the time you get to like 80 odd thousand, you're struggling to actually have child benefit. You've got high income child benefit charge. I couldn't even get my words out there. There's a box on the tax return. So basically what eventually happens is it's sort of staggered. And what will happen is you'll end up paying all of your child benefit back. Now, and it's, without going too deep into it in the podcast, it's very dependent on household income. So you could have one of you who earns 100 grand, the other one earns nothing, and actually you'll end up paying all of the child benefit back. The higher earner will. They'll have to do a tax return just to do that. There are other mechanisms to collect it other than a tax return, but the tax return is normally the way it will work. It's a bit of an unfair system because it's possible that two limited company owners can arrange it so that they both get paid, you know, the spouse and the say husband and wife, stereotypically, 49,000 in one, 49,000 on the other, they get full child benefit. But the 100 grand and one of you earning none gets no child benefit. It's a rubbish system. The government looked at altering it, but they just couldn't figure out, I think, how to physically police this and manage it from a structural point of view. At least that's my reading of the situation. I don't blame them. It's actually quite complicated from a tax and reporting point of view to be able to sort that out. But that's currently where we stand. Now, the reason I've put it on the list is because you can do two things. You can either choose to have the money and end up paying it back, or you can choose to not receive it but count as receiving it, or you can choose to not receive it at all. I think it's worth doing because claiming child benefit, this is not a tax thing, but it has some other benefits like automatically issuing your child a national insurance number and things like this. So even if you don't want it, there is a service that means you can kind of tick the box not to collect it. That might be worth doing just to keep yourself in the system. But I also know plenty of people that are like, especially with self-employed people, they're not sure what they're going to get from 1 year to the next. So they'll have the cash flow of having the money and then worry about paying it back sometime later. So there is a cash flow benefit, you'd argue, to having it. And also just means that at least you've got the money rather than thinking, oh, I should have claimed that. That's an option. So child benefit, you're going to review the claims. Not really a tax, but it is so linked to tax returns. And we've talked about pensions. And then I think the other one that's new this year, so this is mainly to do with sole traders. It's a good idea to start talking about sole traders. And that's that as you get anything together, you've got to start thinking about the Making Tax Digital rules. Now, we've done other podcasts on this, but under the new system, we're going from reporting once a year on a tax return. So at the moment, for most people, you're going to report on the 31st of January every single year. You're now going to have to do that every quarter through digital records. So the way Making Tax Digital work is, number one, you've got to keep digital records. So could be spreadsheet, could be Xero, could be whatever. We're not talking pictures of receipts. That seems to be quite a misunderstanding. We're just talking about transaction details. So dates, places, values, that kind of stuff. Then every quarter, you've got to click a button to send like an in-year update. So it's not quite a full tax return. It's like a digital tax return is I think HMRC have avoided calling it that because it isn't as detailed as the tax return at all. It's literally, if you have the software right, you're clicking a button and it's reporting a few headline figures, but behind that's some transaction data. But you're going to need to be thinking about how you're going to do that. And there's a big rollout to this. So this is very relevant. If your last tax return that you submitted, if you were over £50,000 combined from rental and sole trade, you're going to be in. If you're a partnership or a company, this is irrelevant to you. But if you're a limited company or you're a sole trader and that combined income's over £50,000 in your last tax return, you'll be in from the 6th of April. Now that limit is changing. So it will become 30,000, then 20. So as the tax year ends now, if your income's over £30,000, when you submit that tax return, next April, you're going to be in the Making Tax Digital system. Now, understandably, as an audio podcast, that's a lot of information to take in. You might not be picturing this. So do go and check out, if you go to heelanassociates.co.uk and just type in MTD or Making Tax Digital, we've done loads of blogs on that. If you go to our main YouTube channel, Heelan Associates, and type Making Tax Digital in, there's bound to be a load of videos that we've done there. And we've got a load more coming. I'm doing a survival guide that's hopefully a bit more of a walkthrough of a solution that you might use. Loads of different options there. But you've got to know whether that's going to affect you or not and make sure that you know. Are you doing it? Are you seeking help? Are you getting an accountant to do it? Is the accountant doing maybe the year end and you're doing the quarterly ones? Are they doing all of it? Are they helping you keep your records and bookkeeping? Lots of accountants are working in different ways on this, but I think for most people that's going to be what it boils down to, is how much do you want them to do, how much do you want you to do, and come to an arrangement on what you see then as the trade-off. You might think, well, I'm not paying that to do that, and that's fine, it's your time. You can spend hours doing it, or you might think, actually, I do want to give it to somebody and I'm willing to pay X to do it. I don't think there's a right or wrong answer in all honesty. I've got some clients where it makes no sense for them to pay us to do it. They can definitely do it. And I've got others where they absolutely should pay us and won't. So it just depends on where you are in that journey. So just think about what you need to do. So making tax digital is a massive thing that you need to consider for sole traders. Now, while we're on the subject of sole traders then, there's two ways to do your tax return. I think a lot of people miss this point actually, in that so you can do it under what they call the cash basis or the traditional basis. So if it's cash basis, which is now the default basis, because ultimately that's how most people who don't have accountants submit it. And that is you add up what comes in and what went out of your bank account, or your cash, if it was cash, and you just put those figures on your tax return. Now, it doesn't matter when you did the work. It's just about when you got paid for it and when you paid for things. And that's quite easy to understand. I think everyone's pretty comfortable with that one. Years ago, that used to be rubbish. It had restrictions on it, and accountants and the purists out there would not do it because it could harm you with things like how you could use any losses you'd made. That all got abolished. They're pretty much aligned now. It's a nice thing. In fact, I'd say we do more cash basis now than we do the traditional basis. And the traditional basis is more in line with what limited companies have to do, which is all about dates. It's all about dates and when you did the work. So, for example, if you did a big project, because you're a graphic designer, you did a big project and delivered it in the last 2 days of March, and you invoiced it on the 31st of March, but you didn't get paid it until, say, middle of June, because your client was really slow at paying you. Under the traditional basis, you would account for that money that you've invoiced because you've done the work and you've invoiced it in the year, and you'd be taxed on it in that tax year. And the cash basis, you'd ignore it until the next tax year when you got paid for it. So there are pros and cons depending on how you operate. Another example where this is like landlords. If you got paid 6 months rent up front on the 31st of March, that might feel bad if you've already had 12 months from your previous tenant, and you'd be like, oh, I wish I was on the traditional basis. But then if you did it on the cash basis, that might mean that it takes you into the higher rate of tax. And then next year, you'd hardly have anything on there because they leave and then the next person starts paying you in month 6. There's lots of different pros and cons to doing this. But it's just important for you to know, if you're listening to this, there are two bases. The chances are you're doing cash, but do look it up and consider it. And if you are doing cash, now's a really good time, the end of March, to think, do I need anything in the next couple of months? Now, if you've listened to me for any time, you'll know I'm not an advocate of spending money just to save tax. But if you do need it in the next couple of months, now's the time. So, for example, my business, we have a March year end. We're a limited company. So this is a limited company tip as well. But it only works at this moment in time if your year end is, say, in the next month or so. So my company year end is the 31st of March. So we're already ordering IT equipment and things we know we're going to need in the next couple of months. But if we don't, when we draw that line on the 31st of March, our next tax bill was calculated on those profits in that period. So let's reduce them now. We're not spending any money we wouldn't spend. We're just spending it now because it's going to impact the next tax payment. And that's what you can do. If you're a sole trader on a cash basis, that's worth considering, because you can do really weird things on the cash basis. Like if you've got a load of stock you want to buy, you can go and buy stock. Now, under the traditional basis, you would actually take out any unsold stock in your calculations. It's just the way it works. For various different representational and technical reasons that make absolute complete sense. But on the cash basis, it doesn't apply. So if that's you, buy your stock in advance now. If you were going to buy it, and this is the big thing, do not spend money just to save tax, because it's pointless. If you imagine, let's just say your tax rate is 26%, 6% national insurance, 20% basic rate tax. Now, it could be more if you're higher rate tax, and it's arguably overall less if you take into account allowances if your basic rate, but let's just say 26%. So every £100 that you're spending, you're only saving £26 in tax. That's the way to think about it. So only spend it if you need it. But if you are going to spend it anyway, bring it forward. And I can't round that one home enough. That's probably the most important tip in here. And it applies to limited companies at any given year end. So, if your year ends November 26, you'd want to be having the same decision with yourself in November 26. You wouldn't not stock, because it wouldn't work, but things like IT equipment and stuff that you would get in your hands, delivered to you and usable by the end, you might start to think about those. And again, I would research this, read the blog on our website. I've got a blog that goes exactly with this list that I'm running through with you now, teach you a bit more detail about those things. But yeah, pre-year end spend is actually quite important. But I've seen so many horror stories. So the worst one I ever saw was a client who said, yeah, my accountant's pretty good. I'm just not sure they're necessarily doing everything for me, but they're really good. They ring me up and they said to me, go and buy, you're going to spend a lot of money. You need to spend like 10 grand in the next week. So I went and spent 10 grand on my credit cards and bought like a digger. So what are you doing with a digger? Nothing. It's on the drive and I'm not going to use it.
Why are you spending 10? Well, because it saved a lot of tax. I was like, it did, but even at 40%, you spent 10 grand, you saved 4. So for what? And you're paying the interest on the credit card and going to be paying that debt down forevermore. It doesn't make any sense. So can't talk about that one enough. So it's really good in the right circumstances, but do not just go out spending. I mean, there's a sign behind me on the audio one. We call it tax is a success fee. It's been a kind of mantra of ours for a while. And that's that, look, if you're successful, you're going to pay tax. This myth that rich people don't pay tax is absolute fallacy. They might pay less as a percentage maybe, but they do pay a lot of tax. So it is a success fee. You just want to make sure that that fee is absolutely only the amount you need to be paying and no more. And our system is not set up for that. It's very much set up for failure, because unless you know all these things you can claim, you're going to pay more than you should. And that's sad. And that's obviously part of the reason why I like to do these podcasts, is try and give you some education in this area so you don't pay more. That's the thing. When I was in business before being an accountant, it used to frustrate me. It's like, how am I meant to know this stuff? Why should I pay more tax? Because I either can't afford an accountant, or maybe my accountant's rubbish, or just, I try and do it myself. It's rubbish. So anyway, enough of that. We're going off target. So sole traders, think about, if you're on a cash basis, think about bringing things forward. If you're on a traditional basis, you still might make the investments in things like equipment, laptops, electrical stuff that you can use. That stuff still works without going too deep into the rules. But cash basis is particularly good if you want to stock up on certain things like stock and the like. So think about all that. That's the biggest sole trader tip I can give you. And again, this making tax digital thing, you must think about that. Research it. You've probably got letters. HMRC are doing even TV adverts and things like this to try and get people going. I know we've been writing to our clients about it, although trying to get anybody to read an email these days is difficult because you're bombarded with it all the time. But do your research. Reach out to your accountant if you've got one. Find out what's happening for you. But the limits to bear in mind is turnover of, if you've already submitted your tax return as the time you're listening to this for 24-25 and it was over 50,000, ignore any job income you've got from a PAYE payroll job. We're just talking landlords, sole traders. If those are over 50, you're already in from April 26. If it's 30, it's the next year, so April 27. If it's 20, it's April 28. And if you're new in business, then best practice, you should definitely get into the digital world, but you don't actually have to worry about it yet, because HMRC need to see that tax return to say whether you're in or not. So you've got a bit of time, probably a year or at least, to worry about that. But digital journey is important. And if you are thinking of getting on that digital journey, I'm going to do loads of different shows on this, but my recommended one is always Xero with an X. If you go to heelandassociates.co.uk/Xero, there's I think it's 95% off. It does change, but it's currently 95% off for 6 months or something like that. So it's a really good time to be able to test it. If you don't like it, cancel it at the end. But it's the one that our clients tell us is the best, although we operate many of them for clients. So that's sole traders. That's the main one. Limited company owners. Now, there's a few things here for the limited company owners. Firstly, we said about mileage allowance and getting your records in. That's going to be quite big. You've also got, with other tax year things, you've also got something known as trivial benefits. Now, this one's a bit iffy. I don't want to go too deep into it, but I say iffy, it's because I think ultimately the accountancy influencer market, if you want to use this quite aggressively. I'm not necessarily a fan of doing it this way. But what I would say is that the way the rules are designed is that if I want to buy one of my team a birthday gift, as long as it's up to £50 and it's not in reward for their performance, it's literally just a random ad hoc gift for their birthday. There's an allowance called the trivial benefits allowance. It means the company can buy it. I'll get a tax deduction. They don't get taxed on it. Now, there are other rules, but that's the general gist of it. Directors, so me and my own company, can also work for me. But HMRC knew it may get abused, so there's a cap in a tax year of £300. So the general advice tends to be, well, make sure you're using that allowance. Now, I would not necessarily see it as this allowance you need to squeeze every pound out of, but I do have clients that love this and they do like to look at it. I'm not a big fan of buying £300 or £50 vouchers and giving it to yourself over the time. I think there's a technical argument that says that that's difficult and challenging, so that wouldn't be a suggestion. So I've seen sometimes people will suggest, well, go get your £300 of vouchers now. For me, that's not a goer. I think that, but if you're looking at it thinking, actually, there is a couple of things I would like under 50, there's one particular thing in this last couple of days that's under 50 quid that I want, now's a good time to buy it, right? Just think of it like that rather than this allowance. But it's also, the reason I bring it up is you've also got to consider how many you've had throughout the year and whether you're already over your cap, because it might be the other way. You wait until the 6th of April and then start again. So have a look at where you are with your cap. If you've never heard of this rule before, chances are you've got some space. And if you'd like a little £50 gift in the next couple of days, then that's a good one. Now, we'd spoke about using your personal allowances, and this is massive. And the reason I say it's massive is because my team are doing a load of this at the moment, my payroll team. what you have is quite often people start companies midway through a year. It's very rare does anybody start a limited company who's not already in business anyway and transferring over to being a limited company on, say, the 6th of April. So we did, like, November's a ridiculously busy period. Is every year people start, they come off their holiday, they think about it in October, and by November they've started their limited company. It happens all the time, the busiest period of the year for doing this. So you've done this, and but what that means is sometimes there's a significant other. So we talk about like husband and wife combos, and maybe one of them's a primary child carer. They've got no other income coming in. There's a potential to use their personal allowance by paying them some salary for work they've done in the period, and that can be done. You need to act quickly and you need to get payroll. At the time I'm recording this video, which is very late March 26, it's arguable as to whether you could get this done now, but it's worth thinking about even moving into next year. Is, are we maximising people's personal allowances by paying them payroll salary? The payroll salary gets a deduction from your company profits, so it reduces the company tax bill. Works really well. There are some caveats to that because of how restrictive the allowances have been since the budget in the late 25. But so you might end up paying some tax over. But like, give you an example, we were doing a couple of them this week. So they're really late payrolls, annual payrolls, and they might pay a couple of grand in tax. But in the overall position, they're still going to save at least $1,000 of tax. But when you factor in all the various different tax deductions, not having to draw money in the future, this kind of stuff. So it's a really good one, and it will save, out of many of the limited company ones, this one saves, I suppose more commonly in the situations we see, saves the most amount of tax because it's more we just do more of them. So that's a big one. So review both your payroll and anybody else that you've got who's on the books, significant others, because you might also have decided not to pay yourself. It happens a lot with people who start a business that's not really been able to pay themselves any money. I actually did a video on YouTube recently called Every Level of Director Salary, and it takes you kind of through the general sort of feeling of what sort of salary levels you pay yourself through your business journey. So you might be at what we call a level 1, which is just no money. But actually, if you do it right, you could pay yourself some payroll on paper, do it properly, report it to HMRC, record it in your books, and the company, you count as being taxed on it in that tax year. The company then sort of says, look, that money will be owed to you later down the line. That's often what they call directors loaned. So you're like, okay, it's marked in the accounts as a liability of the company. The company owes it to somebody, owes it to you. And so you captured it tax-free because it's generally going to be under your personal allowance and then usable later. And again, this is all dependent on your situations, because if you've got other jobs or other income, that might not be the case. But where it does save money, that's where it's most often used. Is somebody without any use of their personal allowance, let's do that, because they've just thought they couldn't take any money, didn't realise they could basically do it and earmark it for later. So that's quite a good one. If you have got some profits, you've also got this idea that you can take £500 of dividends. So that's the profits coming out of the company, the limited company, to you as the shareholder. So you've got a dividend allowance of £500 that can be used. That used to be like 5,000, so it's not particularly exciting. But again, small changes. If you're taking nothing, why not earmark yourself £500 of cash? And it's the same deal with the payroll. If you get the paperwork right, you can earmark it effectively in the accounts. It accounts as being taxed on you as the director in the tax year that you've noted and declared it, but actually maybe you take the money later. And that one's quite technical, but there is ways of doing it. And I've written, I don't know how many articles on dividends that you can search at heelanassociates.co.uk, or we've got a whole playlist on them on our main YouTube channel. Have a look. You might be able to fathom from there what you need to do. But if you've got an accountant, check in with them about it, because again, it's another £500 that could come out tax-free if you're not having any other dividends. So limited company ones, I'd say they're the main ones, but we did say about pensions. So on the pensions, the thing with that is, if you're a limited company, you're unlikely to want to, if it's going to be using company money, draw money out of the company. So the company's paid tax on the profits, probably. Then you've taken it most likely as dividend. So you're paying some personal tax on it to then go and top your pension pot up. Because although your pension pot's going to get some tax relief normally, say 20% added to it, if you'd have done it so that your company paid into your, as your employer, paid directly to the pension pot, you haven't, it's tax deductible. I can't get my words out today. It's tax deductible. So you wouldn't have actually paid any corporation tax effectively on that money. And then it's not touching you personally, because you're not drawing it to the paying to your own pot personally. So it goes straight to the pot without any tax on it. And as a result, that is, if you look at many of the content we've done around extraction, how to take money out of limited companies, pensions always feature in this way, because if you think that's a good idea to do from an investment point of view, very tax efficient way. Now, you don't get the tax top up in your pot at the end, but you've saved all the tax in the chain for it to go in the pot. So that tends to be better. Again, I can't give you investment advice. You'll have to check that out. But that is a very, very common scenario where there is a desire to pay into a pension. There's always limits and rules and criteria apply, but it's a very common scenario. So that's your limited company options. And I think that's the biggest one for limited company owners that have been successful, where they're scrambling around. They're normally scrambling around to see if they can make a pension contribution as an employer's contribution. That one definitely needs some check-in to make sure you understand what you're doing before you get that wrong, though. I don't see it very often, but you do get the odd one where someone's made just this payment to the pension, and then you find out later it was a personal payment and it's just ruined the tax efficiency from the company. Obviously, as a sole trader, you don't have that option. You've got to contribute personally, or if you're a landlord or something like that, that's a different scenario. So I'd say, as we're approaching the year end, they're the major ones to consider. And then I would look at those things when you switch over to the 6th of April as well. So I'll be thinking about my director's salary for next year if I'm a limited company. I'll be thinking about my child benefit position if I was a person, if I was just a, either way, if I've got kids and I'm getting money, I'll be thinking about the personal tax elements of it. So, and I might be thinking as a sole trader, about my personal spend. So I might be thinking about, not personal spend, sorry, my investment spend. So if I'm going to buy equipment, if I'm going to buy a new laptop, anything else, maybe I really just couldn't afford it towards this company year end. But maybe I'm thinking about, okay, well, actually next year I've got quite a lot of contract work coming in. It's going to be good for me. Maybe you're a freelance. I'm using graphic design again, but I'm a freelance graphic designer. Maybe I want to buy a new MacBook this year, that new Neo or whatever. Actually, if you're a graphic designer, would you use a Neo? Probably not. But, it might be some sort of new piece of kit that you want. And then you'd be thinking, actually, I want to make sure I get it before March, 5th of April next year, just so that I can capture and reduce the next tax bill. So all these things that you're considering now can be considered the new part of the new tax year. So there we go. Hopefully that's just giving you some food for thought about what options are there. I mean, there's other tweaks you can do, but I think particularly if you're listening to this and you're a small business owner and you're a sole trader, the two big takeaways that are really important this year: making tax digital. When is that applicable for you? Do you know what you're doing? How do you get registered? That kind of stuff. And we're going to be doing plenty more content on that as well. And should I be spending any money in the next few days if I'm on the cash basis? I think that's going to be really powerful for sole traders. For limited companies, if your year end isn't soon, i.e. 31st of March or in the next couple of months, if it's in that window, you might be thinking about the similar, what equipment do I need to renew, that kind of stuff. Is there any other little bits and pieces I need to get? That's a good time. But then you're going to be looking at your allowances, your mileage, your trivial benefits, that kind of stuff. And as we said, there's a lot of little personal tax fringe ones. They're the ones that, if you go on the internet and you search tax saving for this year, you're going to get the old, put your money in your ISA and do all that. That's kind of known, right? But it would be remiss of me not to cover it. So there we go. Hopefully you've got some food for thought of what you could be looking at. Now, if you have found today valuable and you like these kind of shows, make sure to subscribe on your favourite app so you don't miss an episode. You can also review us on some of those apps, which would be really cool, because it is like, in this case, it's talking to a camera against a wall, but I do these in my spare time and don't really get to interact with anybody. So if you do have any couple of comments that you want to share, obviously that's fantastic. If you do want to get in touch directly about the podcast, you can do so at info@heelanhassociates.co.uk. For more business insight and tax tips, you can connect with me and my great team across all the social media channels, including, of course, LinkedIn, Instagram. I know a lot of people end up in DMs there. YouTube, of course, on our main channel at Heelan Associates, and Facebook, Twitter, and TikTok. We've slowed down a little bit of activity on TikTok, but I do intend to open that back up later in the year. Do a bit more. It's interesting. I want to make some newer, fresher content. You can also sign up to our 2-weekly HeelanHub Herald, which is an email which contains even more business and tax tips. You can do that on our website. If you go to heelanhassociates.co.uk, scroll up and down, you will get a pop-up box. That would have absolutely, if you've been subscribed to that, everything we talk about today and in more detail would have already come to your inbox. So it's definitely worth signing up there. As I mentioned, if you want to get on this digital journey, particularly if making tax digital is new for you, Xero with an X is the one I would say. heelanhassociates.co.uk/Xero for a great deal. Usual disclaimer, we do get a little bit of a kickback from there, but it is a personal recommendation. It's not something that I would recommend to you if I didn't think it's there. For me, it's the market leader and most of our clients are on it, so absolutely there. If you did want an alternative just for balance, QuickBooks is good. They just released a recent update though, which has made me very sad as a historically sort of pro QuickBooks person. I think the latest update is atrocious, but the mobile app's good and the monies and the features you get is also good. So throw the two around. That's it. Have a profitable and tax efficient week, and I'll see you in the next one.